The tax that hurts self-employed people most is usually not the one they spend all year obsessing over. That is the first truth. Most self-employed people stare at income tax like it is the whole battlefield. They hunt deductions. They talk about LLCs. They buy courses. They hear rumors about real estate, write-offs, losses, and magic structures. They act as if the tax problem is one giant wall and all they need is the cleverest hammer. Meanwhile, a second meter is running the whole time, quietly, relentlessly, indifferently. And because they do not understand that meter, they can spend 5 years tax planning and barely move the number that hurt them most in the first place. I have always disliked that kind of confusion because it wastes two precious things at once. It wastes money and it wastes attention. Attention is what intelligent people use to find the real driver of an outcome. If your attention is pointed at the wrong tax, the wrong lever, the wrong entity, or the wrong story, then intelligence does not save you. It just helps you stay wrong more confidently. That is what I want to correct here. I do not want to give you a bag of cute strategies. I want to show you the meter. Because once you see the meter, you stop worshiping noise and start asking much cleaner questions. What tax am I actually paying? Why does it feel so much worse than I expected? Which strategies change the meter? Which strategies merely make me feel busy? That is how adults think about tax. And the answer begins with a sentence so simple that many people skip right over it. Self-employment tax is not a special punishment. It is payroll tax with nobody hiding half of it from you. That one sentence would save enormous numbers of people from stupid planning if they would just sit with it long enough. When you are a W-2 employee, you see your side of Social Security and Medicare withholding and quietly forget that your employer is paying the other side. The second half exists, but it is hidden from your emotional experience. You do not feel like you paid the full freight because you never actually watch both hands take from you at once when you become self-employed. The curtain disappears. Now you are both sides, employee and employer, worker and owner, labor and payer. The meter that was once split in perception becomes whole in your face. That is why it feels brutal. Not because the law suddenly singled you out because the invisibility subsidy is gone. The source explains this plainly. W-2 workers pay about 7.65% in payroll tax while their employer quietly pays the other 7.65%. Self-employed people feel the full 15.3% because both halves land on their return and nothing was quietly covering the employer side in the background. The pain is partly arithmetic and partly visibility. You are seeing a cost that used to be partially hidden from the way you emotionally processed your paycheck. That is the second meter. And once it starts running, a lot of common tax talk becomes almost useless because most tax talk is about taxable income. The second meter is about active earnings. That distinction matters more than people realize. You can be very clever about ordinary income tax and still barely touch self-employment tax if you do not understand what it is actually attached to. Self-employment tax is a tax on active business income, on labor income, earned through certain structures, on the fact that you are both sides of the payroll arrangement instead of one. It follows work. It follows active income. It follows the human effort at the center of the business. That is why so many self-employed people feel crazy after their first serious return. They say some version of the same sentence, I only made $50,000. Why does this feel like I'm in a ridiculous bracket? The answer is that they are stacking meters without knowing it. Federal income tax, state income tax if they live in the wrong place. Self-employment tax on top. The brain still thinks in one tax. The return reveals 3 or 4. That is when reality finally catches the story. The source is strong on this point too. It says people often believe they are mainly dealing with one income tax problem, when in fact self-employment tax is riding on top of that and changing how the whole burden feels. That is exactly right. People are not just mismeasuring tax, they are misclassifying the pain, and misclassification is where bad strategy begins. Once people feel that pain, they start lunging toward anything that sounds like tax relief. And this is where the tax industry, the online guru world, and the cocktail party rumor mill do some of their best damage. They offer objects instead of analysis, LLC, rental property, another business with losses. Just write it off. Put it in real estate, turn it into an entity, get an LLC, and the tax goes away. None of that language begins by asking the only question that matters. Does this change the second meter? If the answer is no, I do not care how clever it sounds. That is the standard. Now let us go through the fake levers first, because most people need to lose their illusions before they are willing to accept the narrowness of the real solution set. The first fake lever is real estate. People have been taught to treat real estate like a universal solvent for tax pain. If something hurts, buy rental property. If income is high, buy rental property. If tax is high, buy rental property. If the marriage is weak, someone would probably tell you to buy rental property. It has become a kind of financial superstition. And like most superstitions, it survives because it contains a partial truth wrapped around a larger misunderstanding. Real estate can be excellent for many things. It can help with income, tax planning, it can defer gains, it can create depreciation benefits, it can build wealth through leverage and appreciation. It can even produce income outside the second meter under the right circumstances. But if you already have self-employment income from your active business, buying rental property does not travel backward in time and reach inside that meter to shut it down. The source is explicit on this point and references the legal rule that rental income is generally excluded from self-employment earnings unless you are providing substantial services or operating as a dealer. That means rental property may be useful in its own lane, but it does not retroactively reduce the self-employment tax already arising from your Schedule C or other active business income. That is a hugely important distinction. Income. Tax strategy and self-employment. Tax strategy are not automatically the same sport. People keep playing checkers on one board and acting surprised when it does not move the pieces on another. The second fake lever is the LLC. This one survives because Americans love legal wrappers. They believe naming something changes its nature. They think if they wrap a business in the right letters, the IRS will somehow stop recognizing what the business is. But an LLC is mostly a legal wrapper, not an automatic federal tax transformation. A one-owner LLC is usually disregarded for federal income tax purposes, which is a wonderfully rude phrase because it tells you exactly what the IRS thinks of your emotional attachment to the letters, disregarded, ignored. For tax purposes, it is still you unless you make some further election. A multi-member LLC is usually taxed as a partnership by default, and active partnership income does not magically escape the second meter either. The source says this plainly: an LLC by itself does absolutely nothing for self-employment tax. I like blunt truths like that. They save time. An LLC may help with legal separation, contracts, liability organization, optics administration, or later elections. Fine, but if you are expecting the letters alone to shut off the second meter, you are paying for a costume, and costumes rarely lower tax. The third fake lever is what I call cross-person wishful offsetting. This is where otherwise intelligent households start sounding like children negotiating with gravity. One spouse has strong active business income. The other starts or buys into something producing losses. The family naturally thinks in household terms, we lost money over here, so surely that should wipe out the other side over there for income. Tax purposes, that loss may indeed matter to the joint return. For self-employment tax, the meter is far less sentimental. The source gives the exact pattern. One spouse with a profitable medical practice, the other with losses from a software business. The loss may reduce taxable income on the joint return, but it does not reduce the self-employment tax generated by the spouse who actually earned the self-employment income. The second meter runs per person based on who earned the active income. It is not impressed by the romance of a joint filing status. That is one of the most important things self-employed couples need to understand. Joint filing does not mean one self-employment meter. It means some parts of the tax law talk to each other and some do not. Once you absorb those fake levers, the world becomes less magical and much more useful, because then you are finally ready to see the real levers. And there are not many. That is the hard part. People want 10 tricks. Tax law often gives you 2 or 3 serious doors and a hallway full of decorations. The first serious door is limited partner treatment. This is not sexy for the average online tax audience because it is narrower than they want and more dependent on actual legal and economic facts than they would prefer. But the source is correct to include it because it is one of the few places where the law genuinely treats certain partnership income differently for self-employment purposes, where someone is a bona fide limited partner under state law and is economically functioning like a limited partner, not just wearing the label while actively running the show, distributive share income may be excluded from self-employment tax, except for guaranteed payments for services. The deeper logic is obvious. A return on capital is not the same thing as compensation for labor. The second meter is supposed to follow work, not simply any dollar that passes through an entity. That sounds simple. In practice, it is narrow and full of substance questions. Good. It should be a lot of people hear one sentence like that and immediately start fantasizing about relabeling active work as passive capital return with no economic change underneath. That is how you get audited lose and then tell people the law is unfair. The law is not especially unfair here. It is simply asking the obvious question, are you really a limited partner under real legal rules, with limited rights and limited active participation, earning a return on capital? Or are you a working owner hoping labels will do the work that reality will not? That is the filter. The second serious door is the S corporation. This is the one everyone hears about online, and the reason it becomes such a mess is that people hear just enough to become dangerous. They hear that S corporation distributions are not subject to payroll tax and they stop listening there. Then they rush to form an S corp before the economics justify it, before their profit is high enough, before they understand reasonable compensation, before they understand compliance burden, and before they understand that the second meter does not disappear. It simply changes collection method for the part paid as wages. The source explains this very well. In an S corporation, the owner wears two hats. One hat is the worker. That person must be paid a reasonable salary for actual services performed. And that salary is subject to payroll tax, which is economically the same creature as self-employment tax, even though it is collected through the corporation. The second hat is the owner, who may receive distributions of remaining profit that are not subject to payroll tax. That is the opening, not magic. An opening, and the opening matters only when there is real room between reasonable compensation and business profit. That sentence should be framed and hung above every wood. Be S corp owner S desk. If the business generates only enough to justify most or all of the income as wages, then the S corp may create compliance cost, payroll administration, returns bookkeeping burden, and professional fee drag, with little or no actual savings on the second meter. The source says this directly. Electing S corporation status too early often creates more burden than benefit because most of the profit still has to come out as wages. That is exactly right. The S corp is not a startup costume. It is a profit-splitting tool, and a profit-splitting tool is only valuable when there's enough profit left after fair wages to split. This is also why the lazy online formulas infuriate me. Pay yourself 30%. Use 40%. Just choose half. Nonsense. The law does not ask for vibes. It asks what like services under like circumstances would ordinarily be paid. The source quotes the regulatory standard precisely and correctly. Reasonable compensation is about the value of the services, not some internet percentage of net income. As profit rises, the wage does not automatically rise in fixed proportion forever. That is the whole point of the lever. But it also means you need real factual support, not folklore. That is how adults use an S corp. They wait until the profit is there. They document reality. They respect the compensation question. They understand they are not abolishing the second meter, only narrowing the amount of business income exposed to it through a legally respected wage versus distribution split. That is a sophisticated lever. Used correctly, it matters. Used emotionally, it becomes tax cosplay. The third serious door is where most people think they are already operating, but they usually are not. Business deductions that actually reduce the second meter. The source is very good here because it refuses to let people stay vague. Deductions are not magical simply because they exist. They matter only when they properly reduce the active business earnings of the same taxpayer who is subject to the self-employment tax. That sounds obvious, yet enormous numbers of people keep confusing broad tax reduction with self-employment. Tax reduction, they hear deduction, and assume every dollar deducted is striking the same target. It is not. You have to know which tax base you are reducing. This is where clear thinking becomes profitable. A retirement plan contribution structured correctly inside the business can matter. An accountable plan can matter. Health insurance can matter. Depreciation can matter, proper benefit structures can matter, but only if they are implemented correctly, supported by the facts. And attributable to the same business and same taxpayer whose active earnings are flowing through the second meter. The source says this directly, and it is probably the most practical line in the entire transcript because it rescues people from deduction worship and forces them into attribution analysis. That is the discipline. Do not ask, "Is this deductible?" Ask, "Which meter does this deduction hit?" That one question will save you from a vast amount of useless planning. I want to take this even further because self-employed people often fail here for emotional reasons, not analytical ones. They want dramatic tax answers because the first return hurt dramatically. The bill landed like a hammer, so they go searching for a hammer in response. But the truth is that the second meter is not usually reduced by one dramatic trick. It is reduced by structural alignment, correct entity at the correct profit stage, correct wage determination, correct deduction placement, correct attribution, correct timing, correct expectations. That is not exciting. That is why it works. People hate hearing that because they want the story where the smart person learns one hidden trick and escapes the tax burden ordinary people pay. Fine, enjoy stories. The tax law is much less interested in storytelling than in substance. If the substance says you are working in the business and earning active income, the meter runs to lower it legally. You must change either the legal and economic character of the income or the amount of net active earnings to which the meter applies. Everything else is mostly decor. That is the bottom line. Now let me say something that will make some self-employed people uncomfortable. A lot of you are not being overtaxed, you are being underinformed. Those are not the same problem. I do not say that to be cruel. I say it because the distinction matters. If you think the law is simply brutal and arbitrary, then you will keep searching for emotional relief. If you understand that the law is actually fairly specific about what changes this tax and what does not, then you can stop thrashing and start planning in a more surgical way. The source deserves credit for that. It is not selling rebellion, it is selling understanding. It says the tax feels painful because most people do not understand it, and that once you do, you can factor it into planning intentionally and legally, rather than thrashing from idea to idea. That is exactly the right attitude. Intentional beats reactive almost always. This also means that the self-employed need to stop wearing martyrdom as identity. There is a specific form of small busyness vanity where people talk as if the tax system is uniquely persecuting them because they chose to work for themselves. That is too emotional for me. The system is not singling you out for your courage. It is charging both halves of payroll because there is no employer hiding the other side, if you want to reduce that legally. Wonderful. But do not start with a victim story. Start with a meter story. Which meter? Why is it running? What changes the base? What changes the character? What changes only the label? That is where intelligent planning begins. Now, let me show you how this changes the way you should think about the next 5 years. First, if you are very early, still relatively low profit, and most of your business income is really just a direct extension of your own labor, then the best move may not be a fancy entity at all. It may be acceptance plus cleaner deduction structure plus stronger cash management plus better estimated tax habits. The source implicitly points toward this when it warns against electing S-Corp status too early. If the spread is not there, pretending it is there only adds cost and paperwork. Second, if profit is rising and there is a real possibility of paying yourself a supportable, reasonable salary while leaving meaningful excess earnings in the entity, then now the S-Corp question becomes serious. Not because the internet says so, because the economics finally justify the architecture. Third, if you are in partnership structures, stop daydreaming and get precise. Are you genuinely a limited partner under the law and facts, or just hoping that capital language will protect labor income? That question matters. Fourth, if you are talking about deductions, force every advisor and every planning idea to answer a brutally simple question. Which base are we reducing? Income tax, self-employment tax, both. If only one. Which one? That question alone will eliminate a mountain of expensive confusion. Fifth, stop using objects as tax fantasies, real estate, LLCs, another business, another entity, another account, another deduction theme. None of those should even enter the room until someone can explain exactly how and why they changed the second meter. That is how serious people keep from being sold decorations. And I have to say one more thing about stage of business, because the source is right there too, and a lot of the internet is not tax structure should match business stage. That is a much more adult way to think than asking for the best entity in the abstract. There is no best entity in the abstract. There is only a better or worse fit for the actual economics in front of you right now. Small profit with heavy labor dependence is one stage. Large profit with a supportable wage gap is another capital. Intensive partnership return is another. Good planning is stage specific. Bad planning is category worship. That is why I distrust tax content. That sounds too universal. Universal rules are wonderful for selling. They are terrible for law. Law wants facts. Facts want context. Context wants humility. That is the actual ladder. Now let me tell you what I think the real lesson is here. Beyond entities and structures, self-employment punishes naivety faster because it removes withholding camouflage. That is the hidden gift pain, creates visibility. Visibility creates the opportunity for real understanding. A W-2 employee can spend years not really seeing the employer half of payroll tax emotionally. The self-employed person gets forced into a sharper encounter with the tax system that hurts fine, but pain can produce clarity if you are willing to use it properly. The mistake is to respond to that clarity with noise instead of analysis. Do not turn the pain into random motion. Turn it into precise planning. That is the adult response. And once you do, your whole tone changes. You stop talking about tax as if it were one giant evil fog. You start talking about active income, entity character, wage versus distribution, attribution of deductions, and economic substance. That is when real savings become possible, because now you are finally arguing with the correct part of the law. I respect that kind of thinking. It is much closer to how capital allocation actually works. You do not beat the market by being emotional about the market. You beat it by understanding what variable is actually driving the outcome. Tax is no different. If the second meter is the driver and you spend all your time polishing the wrong dashboard, you should not be surprised when nothing changes. So here is the final test. If you are self-employed and tax pain keeps surprising you, ask yourself 4 questions. Do I actually understand that I am paying both sides of payroll tax? Am I chasing income tax strategies that barely touch the self-employment tax base? Is my business actually at the stage where an S corporation creates a real wage versus distribution spread? And when someone offers me a deduction or structure, can I explain exactly which tax meter it changes? If the answer to those questions is no, then your problem is not that you need one more trick. Your problem is that you still cannot see the meter. See the meter first, then plan. That is the right order. Because once you finally understand the second meter, an enormous amount of tax nonsense dies on contact. And that is usually the moment real savings finally begin. And let me leave you with one more distinction that almost nobody prices correctly. A painful tax bill is not always the worst outcome. A misunderstood tax bill is worse. A painful bill at least tells you something true. A misunderstood bill sends you running toward the wrong strategies, the wrong entities, the wrong deductions, and the wrong advisors for years. It does not just cost money today. It compounds ignorance into the future. That is why I would rather see you face the second meter honestly now than spend the next 5 years decorating your return with ideas that never touch the actual source of the pain. Truth first, then leverage, then structure, then savings. That is the order. Not fantasy first. Never fantasy first.